Markets are currently very much in celebratory mode, but this leads me to question, are we celebrating too much, and are we just going to the absolute maximum without factoring in any possible risk and possibly even over rewarding potential outcomes? I think the answer to that is yes. And in this video, I'm going to explain the various areas I'm seeing this take place. And it's virtually everywhere, from earnings to CPI data to Fed optimism. And it's been present throughout the year since SVB. A lot of it hasn't materialized, but some of it has. And the part that somewhat debatably has been earnings. Some areas of the market are reporting stronger earnings. And so far on the surface of things, one might look at earnings and say they're positive. Let's not forget, for the last 10 consecutive quarters, I believe, and throughout most of Wall Street history, stocks beat expectations. That's what tends to happen. Wall Street analysts are relatively conservative around that. They beat expectations. There's an emotional high around that. So far, we've seen some banks beat expectations and do well, some other banks not. I would look at earnings ex banks, because banks were a very, hot button issue. How are they going to handle the aftermath of SVB, which occurred at the end of Q1? The stocks are very cheap and they're producing record earnings because interest rates are very high, the highest they've been in the last several decades or couple decades plus, or at least decade plus, a very long time. And the economy has grown and the money supply has grown, although it's now shrinking. And financials will put them in their own bucket. But you look at the rest of the earnings and the picture is not so good, even when companies beat. You look at a company like Lockheed Martin today, beat earnings, up in the pre-market, over 1%, down 2% as the day goes on. Delta Airlines, up 4% pre-market, down that day, down the next day. It's somewhat shocking, but it's also not shocking because a lot of these stocks have tremendous run-ups. They're priced tremendously expensive. Many stocks priced near all-time highs and certainly near all-time high valuations. The market is almost at new all-time highs overall, despite the risk-free rate of return having gone up and earnings having gone down. Still can't totally wrap my head around that and not say it's expensive, considering how expensive I thought things were at the peak. But here we are. This is what the market's giving us, and I'm sharing simply my opinion that I happen to think it is quite expensive. It's for you to make your own judgments on, and the people who bet against me have done quite well this year, so props to them. It's been the right call to be long and to be buying stocks that are expensive. Anyways, earnings are continuing to decline. That is the fundamental story. And we're seeing very economically sensitive stocks like J.B. Hunt, a train and railway company, not doing so well. That's a possible recessionary sign or indicator. We're seeing various recessionary indicators. We're seeing lots of manufacturing recessionary indicators. We're seeing Europe in a recession. We're seeing China growth not being as good. Yes, the United States growth is good. However, it's important to note that while United States growth is good, earnings are still declining. That is not the ideal combination. Normally, you have growth growing and earnings growing. That is not the case in the current environment, which I find very important, highly notable. Market, again, doesn't seem to be pricing that because it's pricing absolute Goldilocks, expecting an earnings trough. However, I don't necessarily think earnings are troughing, and I don't think earnings are going to reaccelerate in Q4 of this year, which market analysts currently forecast at 7.5% growth year on year in Q4. I think that's a tough ask. That was an old ask, in my opinion, when people were expecting rate cuts towards the end of this year. However, that's no longer the case. As the possible recession has been pushed out further, as the economy has remained more resilient, the possible end in the Fed tightening has also been pushed out. And the goal of the Fed tightening is to achieve below trend growth. This is the Fed's stated goal. They want below trend growth. They're trying to achieve growth. Let's not forget, I believe Q1 and Q2 of last year were negative GDP. So these last two Qs being positive GDP, it's compelling, but not a huge deal in my opinion. Particularly when the important thing is earnings and they're declining. So, do I think growth is going to continue to slow? Yes, I do. I think interest rates continuing to go up is going to continue to suppress growth. I think in Q2 interest rates were rather low. They're starting to come up. Yes, in the last week they've come down, but overall the trend is a higher 10-year yield this quarter than last quarter. Way more credit contraction. You look at auto loan approvals and rejections, they're like at decade plus highs. That's an important thing. Car values is an important thing. The ability to sell and buy a car, move that money, have that money velocity is very important, particularly at a time when money supply is going down. So I expect these forces not to be bottoming out and reversing here, but to be continuing to pick up. These downward economic trends, continuation of the credit contraction, new bank requirements, capital requirements coming next week that are going to constrict additional lending from banks. These are things that are going to have effects on the economy, because let's not forget, when loans are occurring, borrowing allows consumers and the economy overall to spend more than it earns in the short run. But we're able to spend less if there's less credit available, and that's a thing that's going to impact future growth. I don't know how much the analysts are putting that in, but that's something I see. That's something I'm noting. And I expect GDP to continue to trend below trend, continue to slow and go in the downward direction. Whether or not it actually goes negative, that's semantics, in my opinion, because earnings are declining despite positive GDP. So I'm seeing plenty of signs that the future is not as good as the past, and the market is currently pricing as if the past has occurred. Yes, the market will bottom and reverse before the absolute low. It's not a perfect correlation to GDP, but I think we've got several quarters of continuing slowing growth and continuing declining earnings, and I don't see that 7.5 earnings bump in Q4. I think in Q4 we're getting closer to a possible negative GDP print, and I don't know what that's going to do for earnings. We're definitely seeing signs of slowing down. Even Apple reporting negative earnings. I get it, better than expectations, but that is worth an emotional post-earnings afternoon bump of 1% to 2%, 3%, whatever it is. But I don't think it's a good fundamental thing for the business for earnings to be declining, particularly when upgrade cycles are lengthening. I get it. Foreign growth is definitely a good thing, particularly for Apple. But I'm not viewing it as a Goldilocks picture that is currently being priced in comparative to the there is no alternative period of incredibly low interest rates and an earnings multiple that is roughly 50% higher than where it traditionally is, even in post-buyback eras for Apple. So, finally, Janet Yellen today talking about how it's not time to celebrate the June CPI. That's what the Fed's saying. That's what I believe. You look at oil prices, they're coming back up. So I think it's only a matter of time before that gets a re-acceleration in CPI. That's not good. That's a whole mixed bag of can of worms that is not going to be fun. And if oil prices break out, yes, the Fed doesn't watch food and energy, but they're going to hike if energy prices are going up. They're not going to celebrate if energy prices go down. They haven't celebrated. They've continued to hike. But it's been a temporary supply glut because of the SPR. That was the method of choice by the government to bring barrels down or to bring prices down. They've drained some 200 million barrels plus from the SPR. That's a lot. That's a lot. So I'm not super optimistic on the oil CPI front. And I think the market is celebrating that a little too soon. So basically within striking distance of all-time highs for the overall market, I think it's definitely a stretch. But here we are. Here we are. This is the best I can tell you. This is the best I can do. All I'm doing is giving you my best thoughts, but this is, we'll see what happens. So that's today's video. I do think we are celebrating a lot. I think we're celebrating everything possible to the maximum extreme. I don't know how we go up from here. Simple as that. That's today's video. And until next time, peace out.